be diversified, take risks seriously, and don't chase returns just because AI is the thing that's doing so well. It could have another really good, robust year ahead of us. It could have an absolute disaster of a year. Don't chase it. Don't put all of your money in those areas. Keep your trust in God, not in your investments, but diversify because we trust in God and we take him at his word.
Right.
Bad things do happen. Stock markets do crash. So have diversification. Doesn't prevent losses, but it helps to potentially lessen the impact of those losses if you were all in just one thing that went down to zero. Welcome to Life in the Markets. My name is Tim Russell, and I'm here with my friend and colleague, Stephen Rohrer, and we are going to be presenting to you a very special Life in the Markets episode. We're going to be giving you a recap of our annual client letter, which takes a little bit of a look back at 2025. We look forward to what we think about 2026, and then give you a couple closing thoughts and comments. So with that being said, Mark Cuban is a famous investor, Shark Tank guy, personality. He said, and this is probably not unique to him, the only constant in business is change. And this is certainly a truism that we recognize as we look at entering the new year, looking back upon 2025, there was a lot of change, right? We had, what were some of the changes? We have new administration.
Yep.
We have the inauguration itself pretty much went as you expect, but then with the new administration comes a lot of new policies. Changes in tax law. We've got ever evolving society. We've got wars and conflicts, and things change. But of course, the more things change, the more they stay the same too. We saw some pretty big losses this year within the Christian community, right? Got John MacArthur passing away, Vodi Bakum. Yeah, that was a surprise.
And Charlie Kirk as well.
Yeah, I mean, and among many others, I'm certain. But obviously, there's some giants in the faith that we lost this year. And yet, like I said, the more things change, the more things stay the same. Or as Solomon said in the book of Ecclesiastes, what has been is what will be. And what has been done is what will be done. There is nothing new under the sun. And I would say coming into 2026, that right there is something that brings me a lot of comfort, because we serve a God who has not changed, who does not change, who will not change.
What a comfort.
Yeah, and because of that, we can enter a year with ongoing development and change, with the confidence that our God is the same yesterday, today, and forever. He will be true and faithful to all that he has said. He will accomplish all that he's promised. And, it is that we place our hope for the future upon.
Yeah, because he is our living hope.
Yeah. Yeah. All right. So with that being said, we'd like to pause and let's look back at the year that was 2025. And I will say before we get into this too far that we have a copy of the letter that we're sending to our clients. It'll be available in the show notes for this episode. So make sure you go to the link or check out the notes section of this episode, and you'll be able to find the print version of what we're going to be talking about today. So when I think about 2025, one of the words that comes to mind is inflation. How was inflation showing up last year?
Well, inflation definitely has been a major topic the past several years. Last year in particular, President Trump with the new administration really made that an emphasis and put a lot of pressure on the Fed to cut rates, because as the rates had increased, again, to help tamp down the inflation, then you're also dealing with jobs and then the pressures on the lending industry. So now with the Fed managing that, that's been a good thing. But President Trump has certainly been very, very focused on both the interest rates and also the jobs and the interaction between them.
So, I mean, you're right. All of those things are definitely happening. We're also seeing like tariff have impacts on pricing. We're seeing that there's a different experience with people of a lower income to a higher income with regard to how inflation is affecting their spending. So if you look at, and this is something we've talked on this podcast an awful lot about over the last couple of years, if you look at the spending habits of those in the maybe the low to moderate income classes, their spending habits have fundamentally shifted from buying things that are the nice to haves, so really focusing on the need to have and trying to have budgetary discretion or being a little bit more conservative fiscally. We also see that we're also seeing that same kind of a habit actually show up in even higher moderate to higher income categories. So one of the fastest growing segments of places like Walmart and Target it's actually the higher income population. So that tells me that a lot of people are interested in finding a value and a bargain because people are tired of the very high prices. So economics is really all about finding out what are the causes of human action. That's really what the science of economics is, thinking about human action. And we are seeing very interesting human action as it relates to inflation. And as we said, inflation right now looks like it's tied to the idea of tariffs, and it's not the only thing. Believe me, I mean, taxes and overspending from many administrations, both R's and D's, are part of what's causing the inflation to be so particularly problematic. So I can't pin it all on tariffs, but tariffs are a factor. So let's talk through how are tariffs showing up last year. What are the things that we should be aware of with regard to how tariffs affected us?
Sure. Yeah, I mean, when the tariffs were announced, a lot of companies increased their prices right away to cover their costs. I know many friends in different industries, and their companies just baked that cost in right away. And for the rest of the year, whether or not the tariffs actually stuck or not, they just left it in there because no one knew exactly what was going to happen. And so it was safer for them as a business to just leave it in. So many of us have seen increases in prices just because companies didn't know what was going to happen, and they hedged their bets and raised their prices based on potential tariff.
And frankly, they had cover to do so because everyone was talking about tariffs. And so everyone knew prices were going to go up.
Right.
So, I mean, maybe that's not such a great thing. I mean, it's not. What's interesting is that we had the Donald Trump Liberation Day Declaration, right? This was, we're going to be so rich. We're going to become such a wealthy nation. We're going to be taking all this revenue from all of these other countries and we're bringing it into America. Donald, we need to have a conversation about the way economics work. That's not the way it works. Yes, technically tariffs are coming from other nations. It's the sellers have to pay a certain price to get their goods into America. That is how a tariff works. But if you only think about the first order effect of a tariff and you don't think about the second, third, and fourth order effects, then you're missing the entire point. You see, economics is all about human action. If you raise the cost of a good on a seller, the seller needs to make a profit. The profit means they have to raise the cost of the good. So yes, at the end of the day, the seller is paying the tariff out of the increased cost that he's charging the consumer. So who at the end of the day is actually paying for that tariff? It is the consumer through the higher costs.
Right.
This is the exact same thing when it comes to corporate tax rates. Now, some of you who are watching this are going to be really upset that I say this, but corporations don't pay taxes. They don't pay any taxes, and frankly, they shouldn't pay taxes because every single tax that a corporation pays is paid by you and me. We are the ones who go out and buy their products and services, and we're grateful for those products and services, but to the extent that that corporation has to pay taxes, they pass those taxes along to you and me. It's in the cost. It's built into the cost of the good. You and I pay the corporate taxes. It's not a corporation. It's the same thing with tariffs, right? That's the same idea. This is why corporate taxes are not necessarily a good idea, because it ends up being an inflationary thing. We need to have a more fair, more realistic tax. I don't like the word fair. Fair is a really weird word. It's weaponized too much. It's way too loaded. I think we need to have a more common sense approach to taxation, because we do need to have some kind of taxes, but perhaps not through this double, triple taxation through taxing. So here's the thing that kicks me. You buy a good and it's maybe got 10, 20% increase for the corporate taxes.
Right.
And then also you pay sales tax on that, and you're doing it with income that you paid income tax on.
Right.
There's so many layers of taxes on here. Can we simplify this thing, please?
Staggering.
Yes. All right.
No, but I think the thing for people to realize, and that Trump confuses, is what is being achieved by tariffs. Are the American taxpayers getting more money? No. We're paying more. Now, it may be worth paying more if there are certain industries that we need to have in our country.
Protections.
Yeah. You know, we need to have defense manufacturing. We need to have a certain amount of capability to build things ourselves. And if it may require tariffs if you want to achieve that. So, but that's different than tariffs are making you money.
Yeah. Please don't conflate making America wealthy with tariffs. It's not making America wealthy.
Right.
It may make America more secure to have those industries here, but not wealthy. Hey, the job market has also been one of the things that we've been watching. We've been noticing that while the job market appears right now to be okayish, it's not as okayish as it was maybe a year ago. We have seen the unemployment rate start to tick a little higher. We've definitely seen more layoffs come through. Maybe a lot of this is related to concerns about tariffs and company costs, and maybe companies trying to cut expenses and right-size their staffing. It also could be possibly related to artificial intelligence and the way that maybe AI makes certain kinds of jobs somewhat redundant. Or not necessary. So that's another potential. So we continue to watch the job market. Right now, it's just showing us signs that we got to pay attention. It's not saying warning, warning, warning. It's not flashing warning lights at us.
But it was enough that it actually encouraged the Fed to cut interest rates.
Yeah.
So the market responded positively to that.
Yeah.
So one not as good report could have other beneficial side effects. So it's a complicated situation. There's a lot of different levers that are being pulled whenever you move one.
Well, that, and we don't have a lot of really reliable data right now, especially during the government shutdown.
Yep.
Some of the jobs data that we have is just gone and probably gone forever. So we have to kind of nowcast this. We see where the reports are today, and that's going to help us kind of get a sense of what to expect moving forward. So the stock market over the last year has been really, really interesting. If you rewind to what we said a year ago, we didn't think that the stock market was going to have another double-digit year, maybe not another 20% year, but what we've actually experienced is the market said, hey, Tim, I don't care what you think. Watch what I'm going to do. Right. And in spite of the fact that we had a really rocky start, we had a tariff tantrum, and the market sold off 20%. Since then, the market has rebounded robustly, and a lot of the performance has been driven by artificial intelligence and speculation around artificial intelligence and how much profit, how much value it may have for the entire economy, for the entire globe.
Right.
So stocks continue to do well, largely because all of the negative things that people were expecting really didn't play out. The tariff impacts and the price of tariff impacts were shrugged off because, again, they're passed to consumers, so companies don't really care about that.
And many of them were much larger when announced than they actually ended up being by the time the negotiations were done.
True. Yes.
Yeah.
All of those things are what's driving the stock market performance in 2025. If we also then look at bonds, we expected this year to be a good year on bonds, and it was a remarkably good year for the broad bond market. We saw that as interest rates kept on coming down, bond prices tended to recover. Now, remember, we have room to recover from the 2022 stock market decline and bond market decline when bonds sold off pretty hard. We're at a place now where we're seeing those prices start to creep back up and get back into a more favorable range. So overall, very constructive year for stocks and bonds.
Yes.
Real estate's another area that we like to talk about from time to time because it's an interesting snapshot into the broader consumer market, because what happens in real estate has broad impacts on what consumers are able and willing to do with the rest of their money and their spending. And we saw that in different aspects of real estate has had a very different kind of overall experience this year. Real estate in and of itself did not have a great year. In fact, if you were in certain of the real estate sectors like non-traded REITs or interval funds, you saw them be a little bit more difficult perhaps this year than we've had maybe the last couple of years. It's not an absolute bloodbath of a year. I've seen worse years before, but we recognize that right now with interest rates moving around, with a lot of uncertainty within the market, with a lot of craziness with the overall price of real estate in the country and in the world, real estate's just been something that's right now been in a bit of a holding pattern. So again, we're watching that. I don't think there's anything we need to do about it today, but it's something that is it's on our radar as we head into 2026.
Yeah.
So that might be a good segue. 2026.
Yes.
When we look ahead, what does your crystal ball tell you about 2026? What's the stock market going to do next year? This year, because it's 2026 now.
This year, in
case you didn't know.
Well, let me tell you, it will do exactly. No, we don't.
Get my notes out.
It would be nice if we did know. However, there are certain things that we can look at and historically give us a good gauge of, all right, there may be something to be wary of. There may be some rocks ahead over here. There may be some open water, some room to grow in this area. And one of those areas that you can see some rocks ahead potentially is the area of AI. Yeah,
artificial intelligence has been a common refrain here within the Life in the Markets podcast because it really has driven the market last year. We expect more of the same this year. In fact, we really do expect that a lot of the concerns that we and many others have been articulating about the overpricing of AI names is going to either it's going to work itself out in either positive or negative ways. We don't know if all of the concerns are going to come to bear in 2026. We don't, but we do think we're going to have a lot more clarity as we get into the year and towards the end of this year, just about how influential, how powerful artificial intelligence will be in recasting and reshaping our entire economy. Correct. If AI and all of the AI bulls out there, the people who are really excited about artificial intelligence, if they're right, AI has a really powerful and profound potential of reshaping and rebuilding our economy in some very interesting, powerful, maybe good, maybe bad ways. Right. If, however, they're not right, and by the way, I do think they are right. I think artificial intelligence, whether you love it or hate it, it's here.
And it's
probably here to say, and it is revolutionary. Yeah. It is going to change the world. It's probably My guess is that it's not going to change the world this go around. We're probably going to have a bit of a crisis and wash out some of the names that are more speculative before it actually starts to really get some traction and have positive impacts on companies' profits and the lives of human beings.
Yeah, and similar to the internet, where we know it's transformative, it's going to change things, but because it is so new and transformative, we don't know what it's going to look like exactly and how it's going to be monetized. There's a lot of things that are just up in the air, and we may predict, but how it's actually going to play out is yet to be seen. So that is something that means we need to approach it with humility and also, cautiousness in a wise, prudent manner.
Yeah, I think that's right. So stay tuned. We're going to continue watching AI. Again, I'm not predicting that the stock market's going to crash this year because of AI, although I wouldn't be surprised that there are scares and there are moments of uncertainty because of it. But I will say that AI, the story is not written yet. And we're probably in the second inning. We're not in the ninth inning. Moving on to another driving factor within the markets last year, we really saw gold and silver have a significant outpacing of the overall stock market. The returns on gold and silver were really, really remarkable. Now, some people say, well, look, we want to be in gold and silver because gold and silver is just such a great thing. It's been going up so well and the dollar's going to zero and all of that. And yeah, maybe there's some truth to that. I think it's helpful, however, to keep last year's rally in its right and proper context and perspective. Yeah. So, Steve, you had some information that you'd researched and found about that, you and Jeremy. Do you want to share any of that information there?
Yeah, I mean, just look over the past, 20 years, past. The trick is anytime if you can pick a start date and you can pick an end date, you can make almost anything look really good or really bad. So want to be fair to that, but also look at the big track record of gold and silver. And for many years, it's just hanging in there, maybe doing about what a treasury note would do. So it's not generating anything. That, I think, is the key thing to keep in mind. It's not growing or generating anything of itself. It's not providing a good or a service.
Yeah, so it's not like a business, right? A business produces a good or a service. What does gold make? Gold is a thing. It doesn't make anything.
You put one gold coin in the ground, and you go back a year later, and it will still be one gold coin in the ground. As opposed to, and I think of the parables that Jesus taught, the parables of the talents and the minas, where he gave servants a amount of, a talent or a mina. And he came back after a while and said, "What have you done with it?" And they said, "Oh, well, here it is. I turned your one talent into 10, or I turned your one mina into 5 minas." And you'll remember the one steward, who was a bad steward in that case, he said, "I was afraid. I didn't want you to lose your money. I know that you gather where you have not sown and you reap what you have not planted, so I buried it in the ground." And the master said, "You wicked and slothful servant. I didn't just want what I gave you. I wanted you to do something with it." Yeah. And what was that talent, or what was that mina? It was gold or silver money. That's what that would have been comprised of. And it doesn't turn from one talent of gold to 10 talents of gold by leaving it in gold. It doesn't multiply like rabbits. Yeah. So just ontologically, what is the telos of wealth that God has given to us?
Telos means goal and aim. Yes.
Yeah. It's to do things for our people, for our country, for our kingdom, for our family, to provide things that make people's lives better. And business is the way that is done in many cases by doing things that help people.
So we go back to first principles. We believe investing in companies that help make the world a better place. Gold and silver are good things. They're commodities. They don't actually do that. They don't help make the world a better place. However, they can be a store of value for a period of time, and they store that value with a mixed result. So in the past, if you look at gold starting from September 2011, going through the end of December 31st, 2023, right? Very specific time frame. This goes back to your point earlier. You cherry pick the time frames, you make it look good or bad.
Right.
You see gold had a return of about 4.5% average a year, versus the S&P 500 had an average return. Well, its return was many times that amount. Cumulatively over that period, it was actually up about 420%. That's the S&P 500. Now, if you pause it there and say, well, from December 31st, 2023 till now, who's had a better return? Gold and silver have had a much better return than the S&P 500. But that actually illustrates the point. There are periods of time where gold has these remarkable bright moments where it looks really attractive. And right now is one of those times it looks really good. However, we would caution you about just going whole hog into gold. Don't sell all of your stocks and buy gold now that it's up at an all-time high, or buy silver because it's all at an all-time high. That being said, looking at 2026, I actually think gold and silver could have another pretty solid year ahead of us. I don't think it's going to have the kind of returns we had last year, but it is certainly something that, for me, is interesting to watch as we see how gold and silver develop in the year ahead. Going back to first principles, however, we still are believers in companies that help make the world a better place, that help promote human flourishing, rather than simply holding gold or silver in and of itself. We can hold it in portfolios as a hedge, as a piece of it, but we're probably not going all in gold or silver.
Which, of course, we wouldn't go all in on anything.
Yeah, sure. Well, so let's talk for a moment about taxes. Taxes are a big thing, and as you're filing your tax return for 2025, I want to tell you that last year was a fairly large year for capital gains. If you own mutual funds in a non-IRA account, so it's like a joint account, an individual account, sometimes they're called TOD accounts. These accounts can pay out, these mutual funds can pay out large capital gains every year. And when that happens, you and I will have to pay taxes on those gains. So in 2025, if this has been a common thing, you've had to pay capital gains, I wouldn't be surprised to see that 2025 is another big year for capital gains. So just don't be surprised when it comes to tax time. Also, be aware that within your portfolio, certainly within our biblically responsible portfolios here at the Life Financial Group, we're actively taking steps to over time, slowly convert our mutual funds for exchange-traded funds, which don't have the same requirement to pay out those capital gains. So it'll be a little bit more tax-sensitive for you.
Which, very helpful. But one good thing to remember is when you're paying capital gains tax, it's because your investments have done well. So net, it's a good thing. It's a good sign that, your investments are growing. But we'd rather
manage it as rather gains and losses, right?
Right.
Yeah. The other tax thing that we're aware of is last year we had the One Big Beautiful Bill Act, and that act has a number of provisions that we're going to see potentially impact consumers and impact the broader economy this year. This could be things such as deductions for seniors or no tax on tips or other things of that nature. These impacts will start to be felt this year, and economic actions have economic consequences. So it'll be interesting to see how people respond to possibly having lower tax bills. In addition to that, we also have the impact of some of the economic stimulus for corporations, the allowing them to accelerate depreciation for certain investments in their business. Again, that is going to start having some impacts in the overall economy. It's not just the first order, second, and third order impacts could actually be rather positive here. So as much as I criticize Donald Trump for tariffs and him thinking that they're economically a good idea, I do think that some of the tax code changes do have some economic validity to them. Not all of them, but some of them are actually pretty solid. All right, so that brings us to the kind of conclusion. So what do we do with all of this? How do we think? In 2026, I want you to remember to take risk seriously. Don't go all in on one asset class. Don't just put it all in gold or cash or stocks or AI. Be diversified. Take risks seriously, and don't chase returns just because AI is the thing that's doing so well. It could have another really good, robust year ahead of us. It could have an absolute disaster of a year. That's why don't chase it. Don't put all of your money in those areas. Remain diversified. That's my second point. Remain diversified. Remain defensive. Keep your trust in God, not in your investments, but diversify because we trust in God and we take him at his word. Bad things do happen. Stock markets do crash. So have diversification. Doesn't prevent losses, but it helps to potentially lessen the impact of those losses if you were all in just one thing that went down to zero. And finally, have ample cash on hand. Make sure that you're holding on to cash that you know you're going to need over the next year to 18 months. If you're going to be buying a car, if you're going on vacation, if you're going to making a capital investment in your home, and you have cash in the markets that you're planning on using for that, now would be a good time to raise some of that cash so that it's not at risk in the market. If the market goes up 20%, you'll miss out on the 20% up. If the market goes down 20%, you'll still have your money in cash. I would rather you be on the sidelines wishing you were in than in the market wishing you were out with money that you need over a short period of time. So, with that, do you have any concluding thoughts for us today?
No, I just want to thank you all for being with us this year as clients.
Yes.
It's been an honor to serve you and work with you, and we look forward to helping you for many years to come. And helping you to think biblically and to be the best steward of all that God has given you.
I would also say if you are a client of ours, make sure you send us a copy of your tax return, send us a copy of your retirement statements from your 401ks and other retirement plans so that you and your advisor can work through those and keep them up to date with your financial plan. So proactively get them to your advisor, get them to our team. Secondly, I would say this. If you're not a client, if you'd like to know what it would mean or how it would work to work with the Life Group, go to thelifegroup.org and schedule a stewardship review there. We'd be happy to talk with you about how you can become an even better steward of all of your assets. And until next time, take care, God bless, and be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management. Member FINRA and SIPC.